What is going on at Boeing? You look at their latest numbers and your head starts spinning. The company is trying to climb out of a ditch, but every time they get close to the top, something big drags them back down. That something is the 777X jet. Boeing just reported their third quarter results for 2025, and the story is split right down the middle. They earned a massive amount of revenue and brought in cash, which is great, but they also took a huge financial hit that crushed their bottom line. We need to break this down because this aerospace giant is the core of American industry, and its problems affect everyone from travelers to investors. Let's start with the punch to the gut. The main event here is the 777X jet. This is their next generation plane, designed for long flights. It has been delayed over and over again. And guess what? It's delayed again. Boeing now says the first customer delivery won't happen until 2027. That is a full year later than their previous target. This jet was supposed to start flying commercially way back in 2020. We are talking about years behind schedule. This delay is brutal, and it comes with a huge price tag. Boeing had to take an enormous financial penalty because of this delay, approximately $5 billion. They call this an earnings charge, which is just a simple way of saying they lost $5 billion because this plane isn't ready and they have to cover the costs associated with the holdup. This latest penalty alone dramatically deepened their loss for the quarter. Look at the total damage this plane has caused. This $5 billion charge pushes the total accumulated cost of the 777X program delays to over $15 billion. $15 billion lost just cleaning up the mess and handling the ongoing delays since the program kicked off around 2013. The chief financial officer explained that slower production rates and holding on to planes longer for rework are major factors adding to these steep costs. The CEO, Kelly Ortberg, says they are disappointed, but he claims the plane itself is performing well in flight testing. The real problem, it's not a technical failure of the airplane, but the paperwork and the certification process with the Federal Aviation Administration. He said they have a mountain of work ahead of them to satisfy the FAA's requirements and complete the final approvals. The flight testing itself should go reasonably quickly, but the analysis, the paperwork submittal, and the approval process are taking much more time than expected. This constant delay is forcing major customers like Lufthansa and Emirates to change their schedules and plans. The delay has become so infamous that some experts believe the 777X program might end up having the longest certification timeline in commercial aviation history. This major financial hit led to some ugly overall numbers for the quarter. On an adjusted basis, Boeing reported a loss of $7.47 per share. Wall Street expected a loss, but nowhere near that bad. The final net loss came in at approximately $5.4 billion for the quarter. That's rough, and it immediately made the stock drop about 4% in early trading. But wait, the story isn't all gloom and doom. Despite that massive $5 billion charge, Boeing showed genuine signs of operational recovery in two key areas: cash flow and production. Let's talk money coming in. Boeing generated positive cash flow for the first time in a long time. They brought in approximately $240 million in free cash flow. This is huge because it's the first time they've been cash flow positive since late 2023. Getting cash flow back in the black is a crucial operational milestone, showing they are stabilizing their finances and production discipline. Their operating cash flow was even stronger, hitting about $1.1 billion. Now, look at revenue. They crushed it. Boeing reported total revenue of approximately $23.3 billion in the third quarter. Not only did that beat what analysts expected, but it represents a jump of about 30% compared to the same period last year. Why the massive jump in revenue? Deliveries. Boeing delivered 160 commercial airplanes in this quarter. That is their highest quarterly delivery total since way back in 2018. When airlines actually take the planes, that is when Boeing gets the big money. Getting more jets out the door means more cash in hand, and that is exactly what they did. This increase in delivery pace is critical for stopping the cash outflow the company has been fighting. In the first 9 months of the year, Boeing delivered 440 airplanes, up from just 291 in the same period last year. The demand for their planes is enormous. We're talking massive demand. Boeing's total order backlog has reached approximately $640 billion. That means $640 billion in future revenue waiting to be collected. This massive order book includes over 5,900 commercial jets. That strong backlog shows the company's long-term market position is rock solid despite all the short-term headaches. The CEO put it simply, there's strong demand in our products. Beyond the numbers, Boeing is still battling on multiple fronts to fix its core operations and restore trust, especially with the Federal Aviation Administration. Remember the 737 MAX? That plane has been under intense scrutiny after those two deadly crashes years ago and then the door plug incident earlier this year. Well, they're making progress here. The FAA recently gave Boeing the green light to increase production of the 737 MAX. They stabilized production at 38 aircraft per month during the quarter, and now the FAA is letting them ramp that up to 42 planes per month starting in October. The FAA also showed increasing confidence in the company by restoring Boeing's ability to perform some final safety checks and certify 737 MAX jets for flight. This is a sign that the regulator feels better about Boeing's quality controls. The CEO stressed that if they get approval for future rate increases beyond 42 per month, they will only move up in small increments of 5 jets and no more than once every 6 months. The message is safety and stability first. But even here, it's not all fixed. The smaller and larger variants of the MAX 7 and MAX 10, are still years behind schedule. And don't forget the labor issues. There's a strike going on right now at three Midwest defense plants in the St. Louis area. Approximately 3,200 machinists who build military jets and weapon systems walked off the job back in August. They rejected the company's latest contract offer, and the union is pushing back hard, saying Boeing needs to respect the skilled workers if they are serious about culture change. The union stated that if Boeing is serious about culture change, it starts with respecting the people who make its success possible. Boeing is sticking to its contingency plan, which means hiring replacement workers and leaning on non-union staff during the work stoppage. This current strike, while smaller than the one last year involving 33,000 workers who assemble commercial jets, is another complication for a company trying to regain its financial footing. So, where does that leave us? Boeing is mixing historic delays and huge penalties with genuinely positive operational and financial recovery signals. The big cash flow surprise and the strong revenue beat are undeniable, proof that the turnaround is taking shape, even if the $5 billion 777X delay cast a huge shadow. The CEO, who came out of retirement in August of last year, is focused on improving quality, reliability, and safety across the business, and stabilizing operations to fully recover the company's performance. They're facing deep-seated operational and regulatory challenges that won't go away overnight, but the strong demand for American-made jets gives them a massive runway to figure it out. That is the reality check on Boeing's numbers. They are in a turbulent spot, but the massive backlog proves they have the underlying strength to survive this mess. Let me know what you think about this wild mix of news. Drop a comment below. If you found this breakdown useful, you know the drill. Make sure you smash that like button, hit subscribe, and ring that bell so you don't miss our next market breakdown.